advice. Let's talk about a couple events that stood out in treasuries. Joining us, George Pearkes, macro strategist at Bespoke Investment Group. George, good to have you with us, and thanks. If we could begin with the Fed this year and how we really saw two phases, the hikes into July, the three pauses after, with Powell and his colleagues now comfortably leaning on the lag into the end of the year.
Yeah, I think there's actually a third phase I would add too as well. If you recall earlier this year, we had a pretty big liquidity shock in the form of the blow-ups of several banks that had very poorly managed their interest rate risk and ended up having deposit flight matched with large declines in the value of their securities holdings. So headed into March, we were looking at a very, very tight Fed all year long, very, very rapid rate hikes, et cetera. The Fed then, after what happened in March and after providing liquidity to the banking sector in a series of emergency programs, sort of said, well, we need to see what this is going to do. We're going to keep hiking, but this could have an impact on our forward policy. That led us into the middle of the year when rate hikes started to slow down and peter off. And since then, we've been in a backdrop where markets are trying to sniff out that terminal rate and have had a hard time doing so until I think the end of Q4. So that's actually had a very different impact on the treasury market because some of our wildest gyrations in the treasury market happened after the Fed stopped raising. So yeah, it's been an interesting year and a very dynamic year for policy.
Yeah, sniffing out that terminal rate here has created quite the debate too as well here. And I guess one could argue in some ways it's really four phases now as we head into the end of the year, with the prospect, the possibly a little bit premature, but expectations that we could see some cuts next year.
Yeah, well, the median FOMC forecaster has forecasted three cuts next year. San Francisco Fed President Mary Daly was on the record yesterday saying she agreed with that forecast. That was her forecast. So we will see cuts next year. I think that's very unlikely that we won't see cuts. The question will be, when do we start? Since roughly the end of Q3, my call has been for May. I think March is probably a little bit too aggressive, but keep in mind that core inflation ex rent is running below 1% annualized right now. So there is no reason from an inflation perspective to not hike, or sorry, to not end this period of very restrictive monetary policy and move to slightly less restrictive monetary policy. As inflation falls, if you don't change your policy rate, then you're in fact tightening policy on a real basis. And so that sort of expectation, I think the market got way over its skis, both in terms of short-term interest rate pricing and in terms of the long end term premium in October. That's led to another move over their skis the other direction. Just very hard for the market to find a stable equilibrium for both long-term rates and what their pricing for the Fed is. And frankly, I mean, I think it's possible we see four cuts next year. Excuse me, my brain just having a hard time shifting from hikes to cuts.
We all are, George.
Exactly. So I think it's definitely possible we see four cuts next year. It's hard to imagine getting there without a major economic slowdown or cuts starting in March. And I just don't think the data is there yet to assume that hikes will start in March.
George, getting back to that phase that occurred around the regional bank situation, I'm also reminded of how the resolution of the debt ceiling debacle, there was a lot of attention on U.S. Treasury issuances, the magnitude of which sparked some concerns. I'm also reminded of how back in April we asked you about this and the concerns associated with the U.S. having to fund its massive amounts of debt. You told us, well, if we could have a listen here.
The backdrop for U.S. debt demand is always going to be very solid. We are the world reserve currency. And I can remember going back to the very start of my career, there being constant concerns about what the U.S. is going to be able to do to sell its debt to the rest of the world. How are we going to manage our relationship with China, so on and so forth. There will always be buyers for U.S. debt.
George, you were absolutely right. Do you still feel the same, considering the nuances and the environment associated with things this time around?
I think that the large increase in Treasury borrowing forecasts during the summer did have a temporary impact on Treasury yields. And we saw also once those large increase in forecasted borrowing started to tick down, we saw the reverse move. But there were other factors at play as well. I mean, at the end of the day, in the economy as financialized as the U.S. is in an asset that is the global reserve asset and still will be for the foreseeable future to come, the ability to finance deficits is not something we need to worry about very much in the U.S. There can be impacts on yields from one period to the next, but those impacts are only as large as other sentiment swings can be, or short-term guessing games around the Fed. So mechanically, there's no issue financing U.S. deficits, and going forward, it's hard to see how that's going to become a dominant thing for treasury markets to focus on.
Yeah, I'd have to argue the broader market had the same sentiment in general. Another theme that we discussed this year was how investors really were, primarily focused on the positive. They were discounting the negative. Markets to all-time highs in many ways into the end of the year appears to be an indication of how the bulls, in doing so, in many ways, George, had it right all along.
Yeah, I think economic optimists had it right all along. And, for my part, I was expecting a recession to kick off this year. I think so many people were, given how fast the Fed funds rate rose and how tight policy got, how weak housing demand was. There's just a litany of factors that really caught everyone off guard. And if you don't see a recession, you don't see a major conflagration globally, then EPS are going to hold up. And that's sort of what we've seen this year. Obviously, earnings are off their peak, but we've seen good earnings results, especially outside of the energy sector. Banks have reported rising delinquencies and rising poor loan performance, but nothing to be super concerned about given how extreme levels were. So in that sort of ticking along economy and, big swings from one quarter to the next, but general trend of 3% growth, give or take, that is just not going to generate the kind of headwinds that mean large declines in stock prices. You can also get those large declines in stock prices from valuation, and that's what we saw in 2022 in the post-COVID bear market. But we've moved generally in the opposite way in Q4, and rates fell sharply from March until July as well. So there hasn't been that sort of persistent, steady valuation headwind driven by an increase in the equity risk premium or a change in risk-free rates that would justify a large decline in stocks. So yeah, I think both from the valuation perspective and from the earnings perspective, bulls have had it right this year, as they do most years. Speaking, looking back at U.S. equities, it is very hard to call bear markets in real time, and it just doesn't happen that often. So if you're betting on modest but steady EPS and EPS growth and stable valuations, you're going to win a lot more than you're going to lose.
George, talk to me about another theme this year, the yield curve, the inversion, the persistence associated with it, and some of the ebbs and flows that we saw as we head into the end of the year. Where's the focal point to 2024?
So if we don't see a recession in very short order, we're going to have the first time since the 1960s that a major yield curve inversion didn't lead to a recession. And you could argue that we already had that in the 2019 inversion that didn't lead to a clear-cut recession. Of course, the fact that we did have a recession was entirely because of the virus, and the treasury market was not forecasting COVID in the summer of 2019. But the fact remains that we did have a recession following the yield curve in that instance. So this is the first time we're going to see in 50 plus years 60 plus years that we're going to see a period without a recession that follows a major inversion. And that's something to really think about. I think the nature of the inversion has been important. The market always saw high Fed funds rates as relatively temporary. There was never an expectation that the Fed funds rate was changing on a structural basis. And so that meant that you could have very high short-term interest rates relative to the long end of the curve, which priced a more equilibrium backdrop. You never saw the sort of long-term interest rate decline that would be, in 10-year plus securities that would be associated with extreme risk aversion. Rather, they priced in sort of more equilibrium inflation and real rate risk premiums. And that meant that the front of the curve traded a lot higher because it was going to be that way for a short period. We certainly do have a much higher forecast for the Fed funds rate from the market. If you look out along the secured overnight financing rate futures curve, that looks much, much more aggressive than it did in the 2010s. And, so there's some questions there. But the overall point is that this short-term interest rate surge has been viewed as very explicitly temporary. It hasn't been joined by a very large decline in risk premiums at the long end that would signal a market pricing of recession.
George, can't thank you enough for the contribution you've made to the show here and the Schwab Network this year. George Pearkes, macro strategist, Bespoke Investment Group.